thank you for joining us at this time. Coming up, President Xi Jinping vows to make industrial policy China's top economic priority in 2024. German's Chancellor Olaf Scholz agrees 2024 budget, at least $5 trillion worth of U.S. stocks expires on Friday. Zimbabwe's stock exchange records 225% turnover. These and more after this break. Hi there, I am Omohefe Peace Osemere. On the global economy, let's start with developing Asia, which will likely end the year on a brighter note. The Asian Development Bank on Wednesday said with growth in the region expected to be stronger than previously thought due to a recovery in China's economy, had raised its 2023 growth forecast for developing Asia to 4.9% from 4.7% projected in September, but kept its growth outlook for the region at 4.8% next year. The ADB also revised upwards its growth projection for China to 5.2% from 4.9% previously, but maintained its growth forecast for the world's second largest economy at 4.5% next year. China's economy grew at a faster than expected clip of 4.9% in the third quarter, while consumption and industrial activity in September also surprised on the upside, and that was supported by a flurry of policy measures that bolstered tentative recovery. The ADB said a robust domestic demand, stronger remittances, recovering tourism were underpinning economic activity in the region, which consists of 46 economies in the Asia-Pacific and excludes Japan, Australia, and New Zealand. Well, the outlook for the sub-regions was mixed, with East Asia seen growing faster at 4.7% this year versus the ADB's 4.4% forecast in September, while Southeast Asia was projected to grow at 4.3%, but that's lower than the previous forecast of 4.6%. South Asia was likewise expected to post stronger growth of 5.7% this year from 5.4% previously, with India's economy seen expanding at a faster clip of 6.7% this year. Inflation in developing Asia was forecast to ease to 3.5% this year, and of course down slightly from ADB's earlier expectation before rising slightly to 3.6% in 2024. Well, in what happens to be a letdown for investors hoping to see more forceful stimulus to boost growth, China's top leaders, including President Xi Jinping, has vowed to make industrial policy their top economic priority next year. The ruling Communist Party's annual economic work conference made building a modern industrial system its #1 goal, up a place from last year. The priority for 2023 was boosting domestic demand, which fell to the second spot as policymakers put greater emphasis on developing cutting-edge technology and artificial intelligence. Now let's take a look at the Asian market, where we saw Chinese stocks fall as a key economic meeting disappointed investors with its lack of emphasis on fixing real estate woes or offering greater stimulus. The Hang Seng China Enterprises Index lost as much as 0.9%, with developers Longfor Group Holdings Limited and China Overseas Land and Investment Limited among the worst performance. The CSI 300 benchmark of onshore shares slid 0.8%. Moving on now, the UK economy shrank by more than expected in October as high interest rates squeezed consumers and bad weather swept the country. The economy fell 0.3% during the month after a growth of 0.2% in September. But household spending has been dented by rate rises as the Bank of England tries to tackle inflation. It is due to make its next rate decision on Thursday. Meanwhile, retail and tourism were hit by severe weather in October as Storm Babet lashed the UK. Most economists had predicted that the economy would shrink by just 0.1%, but the services, manufacturing and construction sectors all contracted. The UK economy has been stagnating, and Prime Minister Rishi Sunak has promised to speed up growth. But no significant pickup is expected until January 2025, by which time the next general election must be held. Now, in Europe, the Eurozone industrial production declined by more than expected in October, with the sharpest drop for capital goods such as machinery, reinforcing survey indications that the single currency area is in a recession. The European Union Statistics Office, Eurostat, said on Wednesday that industrial production in the 20 countries sharing the euro fell by 0.7% month-on-month in October, for a 6.6% year-on-year drop. Economists polled by Reuters had expected declines of 0.3% in a month and 4.6% from a year earlier. The month-on-month fall was chiefly the result of a 1.4% decline of output of capital goods, as well as 0.6% falls for intermediate and non-durable consumer goods, such as food and clothing. Production of energy was up 1.1%, and for durable consumer goods by 0.2%. Irish industrial output fell by the most, down 7.0%, while that of Greece was 6.0% higher than in September. The Eurozone economy contracted by 0.1% in the third quarter, and expectations are that it will decline again at the end of 2023, further confirming a recession. Surveys of purchasing managers have pointed to declines in business activity in October and November. Right, Germany's government has agreed, at least initially, to declare an emergency situation, allowing it to focus on net new borrowing next year. This was disclosed to Reuters on Wednesday by two government sources after the budget deal. A spokesperson confirmed on Wednesday a two-party government had agreed a 2024 budget, including a month of fractious negotiations after a court ruling threw its plans into disarray. Germany's Constitutional Court ruled on November 15th that a government decision to relocate or reallocate 60 billion euros, that's an equivalent of $65 billion of unused debt from the pandemic era, to its Climate and Transformation Fund, was unconstitutional. Right now, let's take a look at the progressive events at the European market. Right, you're watching Global Market Update live on Politics and Business Television. Now we'll take you all the way to America, where the Federal Reserve is widely expected on Wednesday to leave interest rates unchanged for a third straight time, but also signal that a pivot to monetary policy easing will neither come soon nor be sharp, given inflation's bumpy progress downward. In quarterly economic projections due to be released at the end of a two-day meeting, U.S. central bankers are still likely to pencil in at least a couple of rate cuts by the end of next year, as they seek to strike the right balance between policy that's restrictive enough to slow spending and hiring, but not so tight that it sends them into a tailspin. Right now, we'll take a look at U.S. stocks, where market participants say dealers squaring their books ahead of duration that is set to be the largest on record for S&P 500 linked derivatives may be helping to turn on swings in U.S. stocks. Some $5 trillion in U.S. stock options are set to expire on Friday. That's 80% in S&P 500 linked contracts. ASIN 500 MRA Institutional, a unit of derivative strategy and execution firm Macro Risk Advisors. This is the largest of such exploration in at least 20 years. A quick break now. When we come back, we'll take you all the way to Africa's stock market. Please join us again. Welcome back. Now, let's take you through some of the markets in Africa. We start off with Malawi stock market. At the end of trading on Tuesday on the Malawi Stock Exchange, that's a total of 1,396 shares, corresponding to a market value of 36 million Malawian kwacha, were traded. Compared with the previous MSE trading day, which was on Monday, December 11th, Tuesday's data shows 136% improvement in volume, but 34% decline in turnover. The market capitalization of the Malawi Stock Exchange as at yesterday was 5.93 trillion Malawian kwacha. In aggregate, 11 MSE listed equities participated in trading, ending with only one gainer, namely Sunbird Tourism, with 0.01% share price appreciation. And on the losing side, NBS Bank came out last with an end-of-day price depreciation of 1.9% at 103.00 Malawian kwacha per share, and that was closely followed by Icon Properties at 0.06%. We also saw National Insurance Company Holdings at 0.01% and FDH Bank at 0.01%. Well, on the flip side, FDH Bank recorded the highest volume of 268,572 traded shares, followed by Malawi Property Investment Company at 264,110. We also saw NBS Bank 45,663 and National Insurance Company Holdings 21,000. Now, when you talk about the performance of MSE market indices, yesterday it was quite impressive. Well, for some and others not, as we saw the benchmark Malawi All Share Index pared 111.60, and that's a 0.1% point to close at 109,806.51. Well, that represents a 1-week loss of 2.72%, a 4-week loss of 3.27%, but an overall year-to-date gain of 77%. Other remarkable indices that performed were the Malawi Foreign Share Index, 0%. We also saw the Malawi Domestic Share Index at 0.12%, and that it means 3.08%, in 1 week, and that's about it for the Malawi stock market. And now, Zimbabwe stock market at the end of trading yesterday, we saw a total of 656 million, 571,300 shares. Well, that's a corresponding, that corresponds to a market value of 2 billion Zimbabwean dollars, which were traded. Now, when you compare this, with the previous ZSE trading day, which was on Monday, December 11th, Tuesday's data shows 225% improvement in turnover. Now, the current market capitalization of the Zimbabwe Stock Exchange is 15.9 trillion Zimbabwean dollars in the aggregate. 18 ZSE listed equities participated in trading, ending with 7 gainers and 4 losers. Zimbabwe newspapers led the gainers with 15% share price appreciation, closing at 32.20 Zimbabwean dollar per share. That was Willdale Zimbabwe 1.4%. We saw Zimri Holdings at 1.19% and Star Africa Corporation at 0.05%. And of course, on the losing side, we saw Edgar Stores, which came out last with an end-of-day price depreciation of 2.86% at 90.0010 Zimbabwean dollar per share, followed by Econet Wireless Zimbabwe at 0.11%. Also, we saw CBZ Holdings at 0.01%. And of course, Edgar's Stores recorded the highest volume at Delta Corporation at 572,400. Of course, OK Zimbabwe at 501,700 and Econet Wireless Zimbabwe at 115,800. Of course, we must take a look at the performance of ZSE market indices, and we saw the benchmark ZSE All Share Index inched up 113.65, and that means 0.06% points to close at 197,806.34. Of course, that represents a 1-week gain of 3.46%, 4-week gain of 15.17%, and an overall year-to-date gain of 914.71%. Right, of course, that's about it for the global market update for today. We'll bring you latest figures tomorrow at this time. Thank you so much for watching. I am Omo Hefe Peace Osemere. Bye for now.